This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend Taylor from Life Goal Investments. How you doing, buddy?
Doing great. What's happening today?
I got kind of a hot topic for number one, and hopefully you don't take offense to this. I certainly mean nothing towards you. Given your Wall Street background, right, a decade on the street, I just want to ask, why are Wall Street analysts such chicken shits or horrible at their job? I'll let you pick either one. Because I haven't seen earnings reductions or cuts, and they always seem to come late. So why are they so bad or chicken? What do you think?
Yeah, does it almost seem like there's an inherent tie for them to have a vested interest in saying things are going higher?
Almost.
Hey, let's call a spade a spade. It certainly seems like that. You look at, like, right now, we put out a post on Instagram earlier this week or last week, I'm sorry, that said right now the average analyst estimate a year out from now expects the S&P to be up 32%. And it's like,
and that's just
wow.
wrong. Let's just
Right.
call it. I'll take the under.
Yeah, are you sure? I'll take a magnitude of the under.
Yes,
honestly,
exactly.
And it's funny because no one says, hey, or everyone's saying we don't expect a V-shaped recovery. Well, what would you call that? If we're up 32% a year from now, and again, like, I put this out and someone said, hey, like, you shouldn't listen to the extremes. And I'm like, hold time out. The operative word there was the average.
That wasn't the most far out. That was right. The average.
Right. The most far out is probably a double. I don't know what the range is, admittedly, but yeah, up 32%. So yeah, I think it's really hard to argue the contrary. The consumer just seems to be weakening, and the data, although slow, seems to be leaking through on the consumer weakening. We could talk about that.
Absolutely.
You can agree or disagree. What are your thoughts, and point me in the direction you want to take?
I like calling it how I see it. Sometimes I'm right, sometimes I'm wrong. I think this week, because dude, freaking July starts Friday, right?
Yeah,
the
right.
Second half starts Friday.
Yep.
So what I put out today on my daily financial news is I think we're going to have some earnings pre-announcements this week. And, if Wall Street analysts continue to be chicken or suck, I'll let you choose whichever one you would like of those. They will then cut after companies have come out and pre-announce. So I'm going to call it early. There's going to be a couple of companies that pre-announce. I think there'll be one barn burner that nobody expected is going to pre-announce this week, probably Wednesday, Thursday. And
you made this call earlier on pre-announcements too,
yeah.
And we started to see them start to leak through, and it's spot on. I mean, like, the consumer. So here's what we look at from a consumer perspective. The big headline numbers that people talk about when they talk about the end consumer is unemployment, and unemployment's still really, really low. 3.6 is where it is. That's historically phenomenally low, but that is, as we always talk about, a lagging indicator.
Correct.
And so that is something that will change right as we enter or have already entered into the recession. So what you see on the other side is that job openings. So how many jobs out there are available? Job openings are starting to not look quite as good. And that's something that may precede unemployment, right? So you see the job openings start to look different, and then it leaks through into unemployment. So that's that. It's no secret right now that inflation is white hot and people are struggling to afford things. And what you're seeing is the highest level of credit card debt we've ever seen. Credit card debt is the highest level we've ever seen. And what's happening with rates on credit cards? Oh boy, they're going up as well. So not only is the debt level high, but also it's becoming more and more expensive. So, I mean, it's tough to look at the consumer right now and say, in our opinion, and people will argue the contrary. There are people out there arguing that the consumer is strong right now. We think it's really tough to believe that the consumer is strong with record levels of debt outstanding. That debt outstanding and the increasing credit card rates that we're seeing is really tough on that bottom kind of, call it, quarter of the economy. They really struggle with rates going up because they don't have the excess cash flow to go in and pay it off. They all of a sudden are taking 20, 25% interest rates in these credit cards right on the chin. And the other end of the consumer is the wealth effect that you talk about a lot, Michael. And you talk about the fact that when the market goes up and people that are rich and are invested start to feel ultra wealthy and start to make investments or buy second homes or whatever it may be. But guess what? When the market pulls back 20%, they also feel it on that end too. So you're now talking about the top end feeling it from a consumer perspective and the bottom end simultaneously feeling it. I don't know. That's what our crystal ball, and it's not perfect by any stretch of the imagination. That's what our broken crystal ball is reading.
Yeah, I mean, when you look at the broken crystal ball, mine's just as broken as yours. It just 68% of the economy is the consumer, and what, maybe 20% of the consumers are doing great, right? Because there is, you know, that upper echelon, they're really never affected. But you know, 70-80% of us people are making choices. And I saw an article just this morning. It's like 55% live paycheck to paycheck. A couple, you know, like 33% of people families that make 200 grand live paycheck to paycheck. Everybody, I mean, I filled up my gas tank. It was like $125 and I have a car, right? I couldn't imagine having an SUV and things. I mean,
I filled up, and I'm on the East Coast, not on the West Coast like you. I filled up a Suburban because I have a kid hauling machine, and it was $152. And I was like, ouch. But you know what? Like, on the same token, and this goes to show you that debt levels have to be increasing, is that the roads were packed. So we were on a little road trip to see my in-laws down in Maryland from New York. The roads are packed. So it's, you know, Americans are Americans. What do Americans do? They spend, whether they can afford it or not. They spend until they can't, and then things get tied down so much that it snaps. And that's what I'm afraid is you know, potentially looming.
So, you know, I don't know if it's the sell side or, I mean, who are the analysts that are going to be sort of get out over their skis and be first, or do they have to see the whites of the recession before they make the cut? I mean, are there any analysts that, you know, maybe or firms, if you don't want to name any individuals, that are like, hey, earnings got to come down for the S&P, because earnings can't happen. It just can't. 32%. Crazy.
They've gone up from the beginning of the year. Earnings estimates have gone up from the beginning of the year. So it's really tough. I'm struggling this one myself. And I don't know. I don't know what it is that's going to cause them. There's obviously, to me, an inherent tie for them to need to want earnings to go higher, right? There is a broader ecosystem there that is supported by higher stock prices, higher earnings, et cetera. But you are now just starting to see some cuts come in. And that's where, like, it's just starting, and the economic news is both of our opinions. I'm not putting words in your mouth. I know you agree with this. Is going to get worse and worse here moving forward.
I'll take that. I'll take that.
Right? You laugh because you're like, that's an understatement, man. Come on. So they'll come down. They have to come down. But it is really frustrating to see that it's been so slow, because there have been other times in the past where it's been quicker. So it's not always, you know, systemically as slow as it is right now. So we'll see them come down, but to your point, it's frustrating because the economic news is pretty glaring, at least from our take right now. And it's not being reflected that way by analyst estimates.
Yeah. So it's not only the US consumers, but I mean, I've been doing this a long time. The other thing I look at is all the multinationals. Dude, can you, and again, I carried quota for Asia and Europe for like the last 5 or 6 years of my career. I could not imagine trying to sell in Europe today. Couldn't imagine trying to sell in Asia. And again, I think my quota for those two areas was probably like 38% of my total yearly nut. So let's just assume it's 40%, right? So if you're 40% of your, you know, multinational company comes from those two regions, Europe clearly in a recession, Asia darn close. I mean, and then, oh, by the way, you have to do a currency conversion, and the strong dollar is going to make all those things. Oh my God. I mean, that's why Microsoft had to reduce. That's why Salesforce called it. I mean, all of these things are adding up going, I mean, these are all negatives on the earnings statement. Why aren't the freaking earnings per share being cut? I don't get it.
Yeah, it really is that. And some of it, I will say, like, as a little bit of a breather, CEOs, et cetera, will blame currencies in times when things
of course they will
a little bit. But nonetheless, it's a legit gripe by folks that have significant revenues coming from overseas right now, because the dollar's strength has been unreal. So, you know, we talk about inflation here, inflation, but relative to currencies around the globe, the dollar strength has been phenomenal. And to your point, like, the European market right now is really, really getting squeezed so hard by this energy, this energy transition that they're trying to make. They are really weighing balance. It's really tough. They obviously want to get as far away from ties with Russia as they can, but especially like Germany. Germany is a manufacturing-led country, and they are an export-driven country based on that manufacturing, and they use a ton of energy, and they made the strategic error 20 years ago to create too close of ties with Russia. And it actually is a post-World War II decision that they made, is that they wanted to bring everyone in the fold and create all of these kind of network effects to have everyone be, of good behavior. But when someone starts acting badly, that network effect is there, and the ties are so tight there that now they're scrambling to figure out where else are we going to source our energy? What other forms of energy can we source efficiently? And right now it's tough. And Russia has year over year increased their exports of oil, which is crazy. Everyone's trying to get away from it, but they've year over year increased their exports of oil.
Yeah, they're selling India, China, Africa,
Yep.
and you think the dollar's strong? Look at the Russian, whatever it is, ruble or something.
Ruble, right?
Yeah, it's a 3-year high.
It's an interesting paradigm that we're all trying to figure out here. The energy quandary that we're in is one that it will be interesting to watch shake out. There'll be a lot of case studies done looking backwards in textbooks on the energy situation we're in.
So back to analysts, and basically it's just inherent in the system. They're not going to make cuts until after, I'm guessing.
Yeah, the risk to them is they make cuts now, and the risk is that things aren't as bad. They are dramatically overexposed in a way where they don't want to be. They've then pissed off a company, not to mention they look bad on their own. And right now, if they can just kind of stay along with the masses, which is what they're doing, and not cutting,
32% up next year. Awesome job, guys. You are so good at what you do. You're either really bad or chicken. You can choose which one.
I think it's chicken more than it is anything else, but we'll see.
There you go. Well, Taylor, where can people find you?
Yeah, follow us at Life Goal Investments. We're putting out on Instagram at Life Goal Investments. We're putting out daily content there on the economy.
Awesome, buddy. Thanks again.